The last item to talk about in connection with revenue is accounting for bad debt and the related balance sheet account called allowance for doubtful accounts, or sometimes called allowance for uncollectible accounts. Allowances are a very important class of balance sheet accounts that allow us to deal with estimates on the balance sheet. There are allowances related to receivables, there are allowances related to inventory, and all assets basically have sort of allowances, right? And there are analogous accounts called reserve accounts on the balance sheet on the liability side, right, that work in very similar way. So we will illustrate this in the context of very specific allowance for doubtful accounts, but all allowances work essentially in the way that they go up by the estimated amount and they go down by the actual realized amount. Okay, so let's see how that's going to work. So if you're in a business that makes credit sales, you will have to deal with customers that fail to pay for one reason or another, and there are two ways how you can deal with that. One is called direct write-off method, which is not allowed under GAAP, but it's useful to talk about. And the second is the allowance method, which is required under GAAP, and this method does involve making estimates, of course. Okay, so let's see. So suppose we make an original sale and book accounts receivable 100,000 and credit revenue with 100,000, right? Of course, when we make a sale, we expect to receive the amount, but sometimes it happens that you cannot receive it. So what would happen under direct write-off method, which is over here, is that we would book the original sale and then we would sit and wait. Maybe we would have to wait for one period, second period, third period, and then at some point we of course hoping to collect the 100,000. But if we fail to collect it, at some point we have to write it off because it's no longer an asset if it's not going to generate future economic benefit, right? So it has to be removed from the balance sheet, and so that is basically achieved by crediting accounts receivable and debiting a provision for doubtful accounts. Okay, so this is the journal entry that happens under the direct write-off method. Provision for doubtful accounts can be classified either as a contra revenue account, in which case it's not viewed as a revenue in the first place. It's netted out from revenue. Or many firms alternatively prefer to treat it as an expense item to show the cost of doing business related or associated with credit sales. Under GAAP, both acceptable, and we will, sometimes think about it as an expense, sometimes as a contra revenue account. But we will refer to this item with this sort of general name called provision for doubtful accounts rather than bad debt expense. But in many cases you can just see bad debt expense, which is more or less an equivalent name. Okay, now under the allowance method, things would work different, right? Under the allowance method, in period 1, we book original sale, and in period 1, we also book the journal entry to account for credit losses that we expect, right? We don't know exactly what amount is going to be. We don't know exactly what customer is not going to pay, but we are still going to try to be cognizant about future losses forthcoming. And as a result, already now in period 1, we are going to recognize an entry that will reduce our earnings by the amount of expected losses, right? So we debit the provision just like we did above, but in this case, we are going to credit the allowance for uncollectible accounts, okay? We credit the allowance instead of crediting receivables because we do not know which accounts receivable are not going to be collected. If we knew, we could have reduced those accounts, but because it's only going to be determined based on future, realization, who is not going to pay and who is going to pay, we cannot remove the exact specific accounts receivable. which of course under the direct write-off method is not an issue, because there we wait until specific customer defaults, so there we just credit receivables. Here we cannot credit receivables, and as a result we use this contra asset account that helps us to reduce the balance of accounts receivable, and this reduction happens due to basically us making credit sales, some of which are not going to be collected, right? So allowance, as usual, so contra asset account, as usual, keeps track of reductions in another account, right? So in this case, accounts receivable are being reduced by the allowance account, okay? So let's see how the mechanics is going to work. Suppose you make a credit sale and you're going to book accounts receivable 100. In the same moment, you are going to credit revenues, right, to show this credit sale. And then, let's say it's 1,000, right? In the same period, or shortly after that, you are hoping to collect most of it, right? And so perhaps you're going to collect 800, which is going to reverse the accounts receivable and increase cash by 800. And the remainder you may receive sometime down the road, right? But some of it might not be collected, okay? And so the idea is that now that you've generated these credit sales, you also want to estimate some of these credit sales that won't be collected. Suppose you estimate that 50 is not going to be collected, and here you basically enter the estimated amount on the allowance account, right? So that's going to be credit to the allowance and debit to provision for doubtful accounts, okay, which is the entry we've seen previously, right? So the allowance account has beginning and ending balance on the credit side, and it goes up by the estimated amounts of credit losses, and it goes down when actual losses happen. So when actual losses happen, we reduce the balance of the allowance to reverse it. And the way this works, suppose in this very period when we generated $1,000 of credit sales, one of the customers very quickly defaulted, and that customer owed us $10, and we know that that's not going to be paid off. So we would basically write off that amount by debiting the allowance for uncollectibles with 10 and crediting accounts receivable with 10, right? So that's how write-off basically is booked. And again, this sort of summarizes how the allowance works. It's a contrast account that goes up by the estimates and goes down by the actuals, right? And it has normal balance on the credit side because it's a contrast account, which tells us some balance of bad debt that is sitting on our balance sheet, right? So it's important to know that the balance of accounts of the allowance tells us what is the amount of receivables sitting on our balance sheet that we don't anticipate to be receiving in the future. Okay, now let's talk a little bit more about how we determine the amount of the provision that we need to book every period, right? The amount of provision or the amount of bad debt expense. Those are pretty much equivalent. So there are two methods. Method number one is called percentage of sales method. This is a very straightforward method, which is a so-called income statement based method. That's because we take an income statement item. In this case, it's going to be credit sales, but we could take sometimes total sales, right, from the income statement, and then we multiply those by some kind of bad debt percentage based on our historical experience, right? So our historical experience was about 2% of credit sales that we generated were not collected, and so we compute the total, 148,000, and then we book provision in this form: debit provision 148.7 and credit allowance for doubtful accounts, contrast account by the same amount, right? So allowance goes up and provision, which is an income statement item, goes up as well, right? So income goes down by the amount of losses that we booked. The second approach is a balance sheet approach because it starts with a balance sheet item, not income statement item. It's called Aging of Accounts Receivable. This approach involves taking accounts receivable that are sitting on your balance sheet, gross receivables, and sorting them based on their age into several buckets, right? So very young receivables, average receivables, and very old receivables. And there can be more buckets, maybe 6 instead of 3, right? But the idea is that in each bucket you are going to have a different historical percentage rate that you anticipate to be received. I mean, the older accounts are, the less likely you're going to collect them. And so for each of this bucket, you kind of calculate the amounts, and that gives you the total. Now, this total is think about it, is a total amount of accounts receivable that are on our balance sheet that we don't anticipate to be collected, right? So by very nature, it is nothing else but the ending balance on our allowance for uncollectibles, right? So we basically calculate here the ending balance of the allowance. Now we have beginning balance, we have write-offs during the period, and we have now ending balance. So under the Aging of Accounts Receivable method, the way we determine the amount of provision is basically by making a plug. Plug, which I always put in a box, basically means that this is the amount that we need to enter here in order to get the ending balance of 67,625, okay? And so you see, we kind of go indirectly here from balance sheet amount to infer or calculate through this plug income statement amount of provision, right? And once we calculated this provision, then we basically make this journal entry over here: debit provision, credit allowance for doubtful accounts, right? So these are two different approaches that we can follow. Okay, so this gives you a pretty good idea of how allowances work. They all work in a very similar way, and we'll work on this more during the class. This is just a summary of what we talked about in relation to revenue recognition, and I won't basically spend time here.